IRAs. The original IRA, sometimes called an ordinary or regular IRA, is referred to as a traditional IRA. A traditional IRA is any IRA that isn't a Roth IRA or a simple IRA. The following are two advantages of a traditional IRA. First, you may be able to deduct some or all of the contributions to it, depending on circumstances. And then secondly, generally, amounts in the IRA, including earnings and gains, are not taxed until they are distributed. On the other hand, a Roth IRA is an individual retirement plan that is subject in many ways to the rules that apply to a traditional IRA. However, unlike a traditional IRA, you can't deduct contributions to a Roth IRA, but if you satisfy the requirements, qualified distributions are tax-free. Contributions could be made to a Roth IRA after reaching age 70 and a half, and amounts can be left in a Roth IRA as long as the account holder lives. The basic requirements of an IRA. First, there is a need to have taxable compensation during the year, wages and salaries, self-employment income. However, any losses from self-employment do not reduce overall taxable compensation. Alimony is considered taxable compensation for IRA contribution purposes, as is non-taxable combat pay. As far as the age of the taxpayer who wants to make a contribution, contributions to a traditional IRA must be made on or before the account holder reaches age 70 and one half. However, there is no such limit for a Roth IRA. Contribution limits. For 2018, the most that can be contributed to a traditional IRA generally is the smaller of the following amounts: $5,500, and that is $6,500 if age 50 or older, or taxable compensation, the smaller of those two amounts. The limit applies to traditional contributions plus Roth contributions combined for any 1 year. In other words, when you combine both traditional and Roth contributions, they cannot exceed the smaller of the amounts discussed earlier. To be specific, a catch-up contribution, which was briefly mentioned earlier, for people 50 or older, we would add $1,000 to the normal contribution limit to arrive at the contribution limit for those who are over 50 or higher. These are called catch-up contributions. Spousal IRAs. These are known formally as K. Bailey Hutchinson spousal IRA limits. For 2018, if you file a joint return and your taxable compensation is less than that of your spouse, the most that can be contributed for the year to an IRA is the smaller of the following two amounts: $5,500, that's $5,500, or $6,500 if age 50 or older, or the total compensation includable in the gross income of both spouses for the year, reduced by the following two amounts. the other spouse's IRA contributions for the year to a traditional IRA, and any contribution for the year to a Roth IRA on behalf of the spouse. So that is how we would determine how much any spouse could contribute, and is by looking at the combined income or taxable compensation of both spouses, reduced by the contributions made by the other spouse, and whatever's left is going to be the limit for the other spouse, but of course always limited to $5,500 or $6,500 if 50 or older. Excess contributions. In general, if the excess contributions for a year aren't withdrawn by the due date of the return, including extensions, the account holder is subject to a 6% tax. Now, excess contribution means that more than the allowable amount, which we just finished looking at, what that maximum allowable amount is. If more than that maximum allowable amount is contributed, it's considered an excess contribution and can be subject to a 6% tax. The tax can't be more than 6% of the combined value of all IRAs at the end of the tax year. Deductible contributions. If neither taxpayer or spouse was covered for any part of the year by an employer retirement plan, the spouses can take a deduction for their total allowable contributions to one or more traditional IRAs up to, and we're getting familiar with this, $5,500 or $6,500 if age 50 or older, or 100% of compensation. Potentially limited, the deductibility is potentially limited if the account holder is considered an active participant in an employer plan. The Form W-2 received from the employer has a box which is used to indicate whether or not the employee was covered, or in other words, whether or not the employee was an active participant for the year. That would be the retirement plan box. And if it's checked, that employee is considered an active participant. And of course, that has a critical impact on whether or not contributions can be deducted. If an active participant, the ability to deduct is either lost or limited when income exceeds, for single or head of household, $63,000, for married filing joint and qualifying widow, $101,000, and for married filing separate, $10,000. These amounts are modified somewhat for a spouse who is not an active participant in a spousal IRA situation. Traditional IRA distributions. Distributions from a traditional IRA may be fully or partly taxable, depending on whether the IRA includes any non-deductible contributions. If only deductible contributions were made to a traditional IRA, or IRAs plural if more than one, then there is no basis in the IRA. Because there is no basis, any distributions are fully taxable. So again, if only deductible contributions were made to a traditional IRA, there is no basis. If there is no basis, then any distributions are fully taxable when received. If, however, non-deductible contributions were made or rolled over to any traditional IRA, then there is a cost basis, an investment in the contract, that would be equal to the amount of these non-deductible contributions. These non-deductible contributions aren't taxed when distributed. They are a return of the investment in the IRA. We would complete Form 8606 if we receive a distribution from a traditional IRA to which any non-deductible contributions were made to any of the account holder's traditional IRAs. Roth IRA contributions. Generally, you can contribute to a Roth IRA if you have taxable compensation and modified AGI is less than $199,000 for married filing joint or qualifying widow, $135,000 for single head of household or married filing separate if they did not live with their spouse at any time during the year, and then all the way down to $10,000 for married filing separate who did live with the spouse during the year. Contributions can be made to a Roth IRA regardless of age. So, in other words, to contribute to a Roth IRA, we need the person who wants to make the contribution to have taxable compensation, or their spouse has taxable compensation, and modified AGI is less than the amounts that we discussed earlier. Note that the ability to contribute to a Roth IRA is not limited by age. Roth IRA distributions. We don't include in gross income qualified distributions or distributions that are a return of regular contributions to a Roth IRA. To say that again, we don't include in gross income qualified distributions, we'll define that later, or distributions that are simply a return of regular contributions to a Roth IRA. We also don't include distributions from a Roth IRA that we roll over tax-free into another Roth IRA. You may have to include part of other distributions in your income. And we order the distributions as follows. The first dollars that come out we consider to be regular contributions. For those of you who have studied some accounting, this would follow the first in, first out rule, where the first amounts in, which are our non-deductible Roth contributions, are considered to be the first amounts received. After regular contributions, we would consider conversion and rollover contributions to be next in line to come out from the Roth IRA. And then finally, we would take into consideration the earnings on the Roth IRA. Those would be the third amounts that we would consider to be come out. The taxable portion, which is the amount required to be included in income because of the conversion or rollover, we consider first, and then the non-taxable portion, and then earnings on contributions. A qualified distribution is any payment or distribution from a Roth IRA that meets the following requirements. So we are about to define a qualified distribution. It is made after the 5-year period, beginning with the first taxable year for which a contribution was made to any Roth IRA set up in the taxpayer's benefit, and the payment or distribution is made on or after 59 and a half, made because of disability, made to a beneficiary or estate after death, or one that meets the requirements listed under first home. Okay, so to kind of recap and to make a little bit clearer, never include Roth contributions in income. Our ordering rules tell us to consider those Roth contributions to be the first amount distributed. We would have a qualified distribution, which means both the Roth contributions and any earnings are not taxable if the Roth IRA was held by the taxpayer for at least 5 years and they meet the requirements for age or disability or death or first home. We consider conversion of traditional Roth IRAs taxable in most cases. Required minimum distributions. We can't keep funds in a traditional IRA, including simplified employee pensions and simple IRAs, indefinitely. Eventually, these amounts in a traditional IRA or SEP or simple must be distributed if there are no distributions, or if the distributions aren't large enough. We may have to pay a 50% excise tax on the amount not distributed. The amount that must be distributed each year is referred to as the required minimum distribution. We must receive at least a minimum amount each year, starting with the year we reach 70 and a half. If we don't receive the minimum amount at that point, then we are subject to a 50% penalty. So, to summarize, we can't keep assets in a traditional IRA indefinitely. We must receive at least a minimum by April 1st of the year following the year that the taxpayer turns 70 and a half. The amount we must get is called a required minimum distribution. If we don't take the required minimum distribution, we are subject to a 50% penalty, or we could call it more formally, an excise tax on the amount that should have been distributed. So we're not taking 50% of the IRA, we're just penalizing 50% of the amount that should have been distributed. Premature distributions. Generally, if under age 59 and a half, we must pay a 10% additional tax on the distribution of any assets from a traditional IRA. Distributions before 59 and a half are called early distributions. The 10% additional tax applies to the part of the distribution that is included in gross income. It is in addition to any regular income tax on that amount. There are several exceptions to the age 59 and a half rule. Even if we receive a distribution before age 59 and a half, we may not have to pay the 10% additional tax in one of the following situations. We have unreimbursed medical expenses more than 7.5% of income. The distributions aren't more than the cost of medical insurance during a period of unemployment. We're totally, permanently disabled. We're the beneficiary of a deceased IRA owner's IRA. We're receiving distribution in the form of an annuity, meaning we're receiving regular, periodic distributions. The distributions aren't more than our qualified higher education expenses, and we use the distributions to buy, build, or rebuild a first home, and the distribution is due to an IRS levy, and then finally, the distribution is a qualified reservist distribution. So before 59 and a half, getting amounts from a traditional IRA is generally considered a premature or early distribution. However, there are many exceptions that can be used to avoid the penalty. Prohibited transactions. Prohibited transaction is any improper use of a traditional IRA account or annuity by the account owner, a beneficiary, or any disqualified person. Disqualified persons include a fiduciary or members of the family, spouse, ancestor, lineal descendants, any spouse of a lineal descendant. Following are some examples of a prohibited transaction with a traditional IRA. Borrowing money from it, selling property to it, using it as security for a loan. Buying property for personal use with IRA funds. Also, and additionally, if the traditional IRA invests in collectibles, the amount invested is considered distributed in the year invested in collectibles. There may be a 10% additional tax on early distributions. Collectibles include artworks, rugs, antiques, metals, gems, stamps, coins, alcoholic beverages, and certain other tangible personal property. However, an IRA can invest in 1, 1/2, 1/4, or 1/10 ounce U.S. gold coins or 1 ounce silver coins minted by the Treasury. It can also invest in certain platinum coins and certain gold, silver, palladium, and platinum bullion. Let's look at some questions. Generally, we must begin receiving distributions from a traditional IRA no later than which of the following dates? Well, our answer is April 1st of the year in which, April 1st of the year following the year in which we reach age 70 and a half. Right there, letter D would be our correct answer. April 1st of the year following the year in which we reach age 70 and a half. If distributions from a traditional IRA are less than minimum required distribution for the year, there may be an excise tax. The excise tax is how much? Well, that would be 50%. 50%. So that is the percentage related to not taking out enough following reaching age 70 and a half. We want to also remember two other percentages. 6% is the tax that relates to an excess contribution, and 10% is the tax that relates to an early distribution or a premature distribution. Sally, 38 years old, converted $14,000 from her traditional IRA to a Roth IRA. Which of the following is true? Which of the following is true? A conversion from a traditional IRA, simplified employee pension or simple, to a Roth IRA cannot be recharacterized. Now, that is related to or pertains to our recent tax reform, because effective January 1, 2018, pursuant to Tax Cut and Jobs Act, which is our tax reform, a conversion from traditional IRA, SEP, or simple cannot be recharacterized. In other words, if it's converted, it can't be converted back, which was allowed before the law. She would not be subject to a 10% penalty or a 6% penalty. This would be our answer.